Wait, guys. I don't think we're gonna make it.
Guys, I just crunched the numbers. I think we can do it.
What happened?
Do you think we can do it?
Well, I
Guys,
think-
we're gonna be late. Let's go.
Yeah,
Let's go.
let's go.
You're late. My time is very valuable here.
Andy, we hear you, okay? Just give us one more chance, please. We made a whole slides presentation just for you. Okay, so first, we're gonna start off with the break even and the target profit, okay? So first, to calculate our break even, we need our variable cost per unit and our fixed costs, our total fixed costs. So yeah, we have a list of all of our fixed costs right here, and that totals out to 689,000. And our variable costs over here on the left, which totals out to around $1 million. And the way you get the total cost per unit, you just divide out the total variable cost by the total units that we used for last year. And so if you go to the next slide. Yeah, so just like I said, break-even point is the fixed cost or the contribution margin, and the contribution margin is just the price per unit minus the variable cost per unit. So next slide. So yeah, we get our sales and our variable costs, you subtract them to get your contribution margin, and then you take your contribution margin and divide it by the number of units, which was 36,200, and you get this for your contribution margin per unit. And now you divide the fixed cost by the contribution margin per unit, and you get the break even, which is 23,278. And then we'll also, I'll break down the target profit as well. So this formula, it shows the required sales with the target profit in mind. And so because you wanted $600,000 as our target profit, next slide. Yeah, we took that into account. So we add the two together to get the numerator, and then we get our contribution margin per unit, which was the same value as the other slide. And we just divide those two together to get the unit sales to attain target profit. So I hope you realize that it's not actually too far gone. We still have a chance to save it.
Alright, let me take it from here. Let's see the most important slide. Cost of goods sold, our projected growth rate is very minimal, only 3%. What does that mean? More profit for us. So you should invest in our company even more. Operating expense, as you can see, fixed costs, most of them is only less than 2%, 1.5%. Some is even 0%, just even more profit. And variable cost is determined by our unit produced with variable cost per unit, which means if we sell more, it will cost more, but if we sell more, our profit will increase. And as you can see, this projected growth rate for the operating expense is also very minimal. Mostly stay at 1.5%. Following our projected growth rate, our cost of goods sold is determined by first we're calculating the unit sale, which is projected to grow as 5.5% each year. So cost of goods sold is been multiplied by that number with the cost per unit times the projected growth rate of each cost. And our operating expense, as you can see from the other table, is calculated by the same amount multiplied by the percentage growth each year. And you can see right now our profit before tax is $434,000 a year, and it will only grow even more if you give us more chance.
Now to explain the income statement a little bit more, we have some percentages. Our growth in profit after taxes is 13.62% from 2016 to 2017. This shows that although our operating expenses and cost of goods sold increased, our unit sales increased by more, so we still grew. Okay, thanks. Okay, now what's important to you? How much cash you're gonna have on hand. So our profit after taxes is $304,000, and then we add that to your salary, $150,000. So the net cash available to you is going to be $454,000.
So we have prepared a 5 years advance financial income statement for you to see. As we know, 1 year is not enough for your approval. So you can see our unit rate is growing at a very constant 5.5%. And from 2017 to 2021, our revenue has grown an increased number of 700,000. Our cost of goods sold and operating expense is growing, but at a very minimal cost compared to revenue. Sir, are you following, Steve?
Oh, wait, what is this? What? Target profitability in year 5? This is not acceptable.
Wait. We know what you're thinking, but we have a plan for 2017 to move production overseas, and I prepared this income statement to show you the numbers. So, if we move overseas, our cost of goods sold decreases significantly for 2017. Just look at that number, 30%. Our total cost of goods sold is going to be $567,000. Sales minus cost of goods sold gives us our gross profit of $1.84 million. Next, looking at operating expenses. Our operating expenses increase slightly, but we have a huge decrease in wage expense because moving overseas is going to be cheaper labor. So our total operating expenses is going to be at $1.2 million, and our profit before tax is $644,000, and then our profit after tax is going to be $450,000. If you look at these numbers here, our growth in profit after taxes increases 68% from last year.
So I know you want to know how much cash is going to be in your pocket. Okay, so next slide. So we take the profit and we add your salary, which is $150,000, and we get to $600,000. That's the number you were looking for, right? Okay, next slide. So basically, if we move production overseas, we get higher revenue, lower COGS, which means we get more profit after tax, and adding your salary to it, we get to that $600,000, that $600,000 mark, just for you.
Now you're speaking my language.
Some ethical things we had to take into consideration as a team is the fact that there could be some unethical labor practices in overseas operations in certain countries, as well as the decrease in product quality because we don't have any boots on the ground in those countries from a lack of oversight, as well as communication challenges that are going to be happening between our company and the production abroad because we are not physically there. And we're going to have a need for additional managers because we're not there.
Let me cut you off right there. I understand the dilemmas, the ethical factors, but I am a money man. I care about shareholder value. That is my #1 priority.
Moving on then to the upsides. If we move overseas, we'll face lower labor costs abroad and have higher profit margins, which you like. And we'll have an absolute advantage in the market because we will increase our efficiency and our overseas operation will be scaled faster, as well as the fact is that we'll be closer to our fabric suppliers and we'll cut our shipping costs, higher lead times in production. So then, with all this, what do you think? So Andy, what's your decision? Are you gonna give us another chance?
I'm in it for the money, but I'm only giving you two weeks, all right? You call my assistant.
Oh shoot, 2 weeks? I should call.